I can paint a pretty positive story. We've got inflation back within the target band, which is a wonderful moment, 2.2% inflation. Pleased there, and that's allowing us to now ease interest rates. We have been a real deliberate constraint on economic activity. So our forward projections are for positive economic growth over the next 12 months, building up to, a 2-3% growth rate over calendar 25 and back to some kind of potential rate around 3 onwards. So it is so pleasing to be able to tell that story, as simple as that.
So you've beaten inflation in this part of the cycle, or could it rear its head from here?
I strongly believe it's beaten, but we have eased monetary policy. It's still slightly restrictive, but we've got time now to just watch the last of the inflation tail come out. But price setting behaviour, inflation expectations, we've got a significant negative output gap. It has not been a fun ride for people in New Zealand, but we're saying the light is now ahead of us.
Some of us had whiplash following monetary policy in New Zealand. You were chugging along in one direction in May. Suddenly you turned to cutting interest rates by August. And then, of course, FX markets were trying to catch up. I think rates markets saw it, but FX certainly didn't. What does this say about the risks when you think that you're setting up for one type of policy and suddenly you're having to change direction?
I'll try and be as quickly as possible. We put out a central projection. And we always say it is a central projection, it is one plot of the line. We then say we're going to be back in a quarter's time and we're going to be telling you whether we think we are on course or not for that projection. Back in halfway through this year we said, look, there's risks balanced either side. One is the continued persistent sticky core inflation. The other side is the negative output gap and a more rapid fall in inflation. And so we said we will be watching the stickiness. As soon as we get confidence that that is easing off, we will be able to ease rates. The great news, all of the indicators came through much quicker, the high frequency ones, and so we were then able to start talking about a return to neutral.
There have been a lot of questions around the state of data collection, and that is pretty much globally, but I think you weighed in on this recently. What do you make of the data you're getting now and whether it's giving you an accurate read on where you're travelling?
We have, like all central banks, we have become highly addicted to as much high frequency data that we can get. With high frequency, yes, it's sooner, it's earlier, but it's also more volatile. So we have to be really careful around what is noise, what is a signal, and we do a lot of parsing of that data. So when we produce our forward projections, we will show quite a significant range of measures of neutral interest rates, potential output gaps, and we talk about where we think we're in there and what indicators matter. Our most recent decisions was largely because the high frequency data all pointed in one direction, and that was inflation declining, inflation pressures declining, and that gave us the confidence that price setting behaviour was changing faster and we could begin our easing process.
Markets like an easy narrative. For a long time there's been correlation between New Zealand and Australia. Now it seems like the gap between the Tasman Sea is quite wide, where you're going one direction at pace and Australia has been holding higher for longer. That said, just in recent days it feels like they may have had a wake-up call. What is the correlation in your view between Australia and New Zealand these days?
We've both got independent monetary policies and our economies have been behaving similar in many ways, but quite different more recently. The first thing is, whilst we're easing, we are starting from a higher level of interest rate. We were more aggressive in our tightening, and now we are able to be easing faster. Australia has been more, circumspect. They've sat somewhere north of neutral. They are being challenged a lot about whether that's sufficiently above neutral or not, and they're playing the waiting game. So we needed to get on top of inflation, a small open economy, particular idiosyncratic shocks that hit us, including storms. We were tired. We're now able to move quicker on the down path.
There are a lot of big topics here that could impact monetary policy, and we've been discussing with the European central banks, for instance, central bank governors, and they are trade fragmentation, geopolitics, climate change. How many of these resonate with you?
Well, we live on the same planet Earth, and that is exactly right. Working backwards through that list, the climate challenges are an existential threat. We worry about it significantly with regard to financial stability, and we do an enormous amount of work globally around stress testing, modelling, and with our banks and financial systems. And on the monetary policy side, it means more volatility, extreme weather events. We've had price, we've had operational shutdowns. So, it's about being resilient, being in a position where you're comfortably in a low inflation, you can afford to look through some of these relative price shocks, but they're real. The geopolitical tension, there's not much we can do about it other than be as diversified as possible in trade and as resilient as possible and flexible in our financial systems. So, a floating exchange rate, multiple trade partners. But I do worry that a lot of asset prices at the moment are totally mispricing some of these geopolitical tensions and threats. By the way, I've been saying that for some time now, and there they are, they're still there.
Which asset prices in particular are you facing?
I think global equity prices primarily. I mean, currencies will come and go, basically, so more around the global equity, not even so much the fixed income. The perfect run has been priced in for a long time, and that story has proved well. Interest rates are coming off, but the price-earning ratios, various measures of fair value, to me feel like risk is being a little bit underpriced.
Asset price deflation can be a big issue for markets, not always the economies, and how they track. What sort of alarm signals can you see down the track? What would you be looking for if there was going to be movement? I
think the best thing we can do is always try and think about what is a fair value, what is an equilibrium, what can be explained through how we understand the economy working, saving and investment balances, relative prices compared to their earnings, just some long-term economic fundamentals, and get away from short-term noise and pretending you can predict the next best thing. It's those long-term fundamentals where pricing has become askew at times. People get too excited, fair value remains well below where current prices are, and so it might be a slower than expected Fed easing that suddenly spooks the market, and you get these oversized reactions. We saw Japan just recently. So it's more about just equilibrium's fine, it'll come back. It's how it comes back. Does it come back overnight in a big shock and a panic and undershoot? Or can you take some of these pressures out by good policy?
You mentioned the Fed, and the central banks definitely managed to cut by 50 basis points without spooking the market and not in an emergency situation. Does that surprise you?
No, it doesn't. I mean, it's they're an inflation target. They've been sitting north of neutral. They've been sitting on the tight side, so they are now in a position where they can say, we can see the inflation and pricing behaviour coming off. We're getting comfortable with the inflation position, so they're just doing their job. You'll move more quickly if you're further away from equilibriums, from a neutral interest rate. No point just dragging yourself along. I mean, that's what we've done ourselves back in New Zealand.
It feels like they've softened the use of the instrument, though, 50 basis point moves. How do you think about those sort of jumbo size rate reductions now?
I don't think about them as jumbo. It's relative to where you are. What's happened in the last 5 years, pre-COVID, people were effective lower bounds, real trouble. COVID hit, we had to go even lower again relative to some neutral concept. Neutral hasn't changed much. We went a long way down, so the tightening felt rapid and fast, but it's because it started from so far below neutral. Central banks got above, got some purchase back on the inflation, and now we can be a bit more circumspect on our way down. But what did the Fed peak at? 5.25? That's still a long way off of Fed neutral.
Where do you think you end up in the cycle? Do you end up at neutral? Is that terminal, or do you think you might have to provide accommodation at some point?
Always hard to tell. Our economic projections and models will always have us inflation returning to target, and in the absence of shocks over time, interest rates returning to broadly neutral. That's our current projected outlook in August. What happens next, of course, is the unknown. What are the relative shocks? How is the economy actually going to be behaving? Do we need to go a bit slower because of stickiness, or do we need to hurry up because irrational indifference has disappeared? You know, people just suddenly give up on the inflation battle, they stop worrying about it, and price setting behaves. I believe in New Zealand we're getting very close to the latter, where wage behaviours, price setting behaviours, inflation expectations are now all consistent with low and stable inflation. So that's allowing us to, to move, the 50 points that we did, and a lot more projected ahead.
Just finally, let me ask you about the US election, because we're just on the cusp of that. And last time round, under a Trump presidency, we saw huge consequences for international markets. It was a noisy old environment. Talk now is if he's re-elected, there'll be even more trade tariffs. How would that impact New Zealand? There is so much deadweight cost going on around the world at the moment because of trade fragmentation, protectionism, and it's just bad. It's poor, bad economics, and people will suffer. Places will be built which will be unproductive, uneconomic as soon as different trade barriers come off. So, resources are getting misallocated quite dramatically. For us in New Zealand, we're 30% China dependent, the rest of the world. If we get stopped out of one of these because of some angry fight in a far distant country, it's bad. And so, I just find it so bizarre, protectionism arguments that are going on now. And China's stimulus, is it going to move the needle on growth in New Zealand?
They've got challenges well beyond just simple fiscal policy moves. They've got the ageing demographics. They're at a middle income inflection point. They have to do things better or do better things. They can't just keep adding more resource. And so that is going to be, a real challenge. I know the IMF's economic forecasts have them, down in the threes over the next couple of years, and that's going to be a real challenge for China and social cohesion.